I want to start a conversation about non-credit score related mortgage denials. I have been in the credit repair business for the last 15 years, working primarily with mortgage lenders and real estate agents and builder sales reps and their non-qualified or credit challenged borrowers. Over the many years that I have been working in this industry, I have become aware that there are plenty of reasons that people can be denied for their home loans that have nothing at all to do with credit score. It's my opinion that many people, as they begin the mortgage process, they feel like once they get that pre-approval letter, everything is on lock. And they are 90% of the way to their new home. But there are so many things that can go wrong and derail a loan process. And in this video, I want to go over my top 10 reasons why you may lose a home loan that has nothing to do with credit score. Before we get started, I want to stress, first of all, that this video is being made at the end of 2025. Loan types and programs change, qualifications change, leniency can fluctuate depending on the economy, and so please consider this video as education and entertainment. And if you are in the market for a new home loan, take this information to your loan originator and your mortgage team and ask them directly about anything that I have stated in this video. And now, with that out of the way, let's dive in. The number one reason on my list is, of course, tax problems or unfiled tax returns. And actually, I'm going to lump into the same category any issue with child support. The reason I'm putting them together is because that one of the solutions that I've seen is for you to have some kind of an approved repayment plan already in effect. If you have back taxes that are unpaid or back child support that is unpaid, but you have a payment plan in place and you have been on time with those payments, there is a possibility that your status on this can be explained and the loan can move forward. All right. Number two. The number two reason is mattress money. And what I mean by that is any money that shows up in your bank account or pays off one of your bills that is unaccounted for, meaning you didn't get it from a W-2 job and you don't have a 1099 for it, so you don't have an explanation as to where this money came from. Perhaps it's a situation where your favorite aunt agrees to pay off one of your credit cards or pay down one of your debts or gift you a down payment. Gifts are allowed, but they need to be sourced properly. So if you are receiving a gift of any sort and it's going to go into your bank account or it's going to pay off one of your debts, please again, visit with your loan team. This is going to create a problem for them if it is not properly sourced. Number three, any job or career changes. Okay, so for example, let's pretend you're an RN and you decide that you're going to go and work at a different hospital and you have no change in your paycheck, meaning you don't miss any payroll periods and your income does not go down. It's likely that there will not be a problem with that change. However, if you decide that and we're sticking with the same RN example, that you're going to become a traveling nurse and you switch from being a W-2 employee to now being a 1099 employee, this is definitely something that you need to discuss with your loan team. Additionally, if you're an RN and you decide you don't want to be an RN anymore, instead you want to go do pharmaceutical sales, this is something that could completely derail the loan, as you are now changing career paths. I know a lot of people don't think about this, but when you're making these types of changes to your life, you are in effect changing that loan application, and the new loan application will need to go in with you under a different career, earning different income. Okay, number 4. Number 4 is any new inquiries or new or increased debt of any kind can derail a loan application. Your loan team only wants to see your existing debt go down, and when you're applying for a home loan, you are applying essentially for the largest amount of money that you will ever ask for in your life. Your mortgage team wants to make sure that you have lots of cash reserves and that your existing debt is low. That makes their job the easiest, and it gets more difficult for them if you are adding more debt, especially if your debt to income ratio is already high or close to the guidelines. So number 5, I've seen this before with my own eyes, and this is too many authorized user accounts on your credit report. This can cause you to be denied your loan even though your credit scores are high enough. That is because those authorized user accounts are not technically your credit or your debt. An authorized user account is when, say, a friend or a family member adds you to an established credit card. Many people do this to help begin the process of rebuilding their credit. It can help them gain credit scores, and it can help them raise their credit scores. Unfortunately, if you have too many authorized user accounts and not enough of your own established debt where you are the primary on those accounts, your credit scores are essentially not real. You have a score, but it's not your debt. So this is unusual, and I haven't seen it very often, but I have seen it a couple of times. Make sure that you take time to build and establish your own credit. Don't just rely on mom or dad's or your spouse's. Okay, so number 6 is overdrafts on your bank account in the last 3 to 12 months. You'll be asked to turn over bank statements, sometimes as few as 3 bank statements and sometimes as much as a full year of bank statements. Anytime you have an overdraft, meaning an automated payment went through and you had insufficient funds to cover it, that is a major red flag with a lending institution. And I've seen this exact scenario derail a loan application. Make sure all of your payments are covered and check your bank accounts daily to make sure you don't overdraft your account. Next one, number 7. You can have great credit but have insufficient or unstable income. Lenders obviously prefer stability and predictability. There is probably a path forward for people that have fluctuating income or unpredictable income sources. But this is something that needs to be laid on the table early on and have an open and honest conversation with the lender so that they can help you navigate this. Okay, number 8. This one has to do with when a mortgage lender pulls a CAIVRS report. CAIVRS stands for Credit Alert Verification Reporting System. This report will be pulled for all FHA, VA, and USDA loans. This reporting system actually tracks government-backed debt. So for example, if you have unpaid student loans that are perhaps no longer showing on your credit report, they may still be listed in the CAIVRS report. I have seen loans derailed when a mortgage loan officer discovered something in the CAIVRS report that needed to be addressed. My best advice is to talk to your loan officer if you think there is a possibility of unpaid student loans or any other unpaid government debt. Let them know ahead of time. Most loan officers work by commission, And so they are motivated to help you get this loan done because that's how they get paid. Unfortunately, they can't help you fix problems they don't know about. So have an open and honest conversation with your loan officer about what you think might be out there so that they don't have to discover it on their own. All right, number 9. Number 9 is judgments. So judgments are no longer reported with the 3 credit bureaus. They're no longer reported to Experian, Equifax, and TransUnion. They are kept in a separate database. And often you will not know if there's a pending judgment until it gets to title. By the time that your mortgage loan has gone to the title company, you've already paid for inspections, you've already paid for appraisals, you've done all these things, and now it's at title, and title looks to make sure there's not anything that could become a lien holder against your real property. And so if a judgment is found, it is very likely that you will have to pay it off prior to moving forward with your home mortgage. If you think there's going to be a problem or you suspect there may be something out there, please give your loan officer a heads up. Number 10. Number 10 is bankruptcy or foreclosure or previous foreclosure. Your credit scores may have recovered, but you may still be within the waiting periods. Over time, the waiting periods have actually changed based on the loan type. This video is being made at the end of 2025, and the current standards require that for FHA, VA, and USDA loans, Chapter 7 bankruptcies can buy within 2 years after discharge, and a Chapter 13 can actually buy while in bankruptcy as long as there is an approval from the court or trustee. For Fannie Mae and Freddie Mac, so that's conventional and conforming loans, there is a 4-year waiting period from discharge on Chapter 7 bankruptcy. Some lenders may actually consider 2 years if there is documented extenuating circumstances. Perhaps that could look something like a divorce or a job loss that is not likely to repeat. For a Chapter 13 bankruptcy with Fannie Mae or Freddie Mac, conventional and conforming loans, it will be 2 years from discharge or 4 years if the case was dismissed instead of discharged. Why longer for the dismissal? Well, on Chapter 13, it is a bankruptcy with a payment plan. And if there is a dismissal, it appears as if you were unable to meet your obligations or make those payments. Now let's talk about foreclosure for FHA, VA, and USDA loans. It is 3 years after foreclosure or title transfer, and 1 to 3 years if there are extenuating circumstances for Fannie Mae and Freddie Mac. 7 years is standard, but with a larger down payment or some other compensating factors, some lenders may consider a 3 to 4 year waiting period. This list is long, but not entirely complete. You can also lose homes for things that have to do with the condition of the home, especially if you're not buying it as is, but you're asking for an FHA or a VA loan. I'm not going to get into these today because I feel like this video is already running long enough. If you have ever experienced a mortgage loan turned down for something other than credit score and other than something that I have listed right here, I'm so curious as to what that might be. Please drop it in the comments so we can all discuss. I hope this helps you. This is not at all to scare you. It is to prepare you and to remember to have those open and honest conversations with your loan team so they can help you navigate this and you don't find yourself in sticky water and losing out on your new home loan purchase. Thanks for being here. I love having you here. Drop your comments and questions for me, as I love to respond and continue this conversation. I'm Lori Ross with High Point Insurance Solutions and High Point Credit Advisors. Have an amazing week. God bless.